In this week's update, market levels continue to recover after the sell-off, eyes fall on the dollar and minutes from the Fed, and results arrive from some of the country's biggest dividend-paying companies. Plus, there's a letter from Warren Buffett in the post. Markets in the US remain closed on Monday for President's Day, but elsewhere the week started in a generally upbeat mood, with equity markets posting further, if modest, gains. The MSCI World Index was gunning for its sixth day of rises in a row on Monday, and at time of writing had recovered about 40% of the losses it had suffered in the recent sell-off. The rise in share prices has coincided with a return to calm in markets, with the VIX index of expected future volatility dropping back below a reading of 20, having spiked above 36 during the recent market falls. It remains some way above 10, however, where it has spent most of last year. Much of the market commentary as the week got underway was devoted to diagnosing the causes of the recent downward trajectory of the US dollar, which remained near a three-year low against other currencies on Monday. The dollar index, which pegs the currency against six leading global currencies, fell by almost 10% last year and is down a further 3% this year. That's despite traditional fundamentals appearing to offer support to the dollar. The potential for further tightening of US monetary policy, which has spooked both bond and equity markets this month, should provide support to the currency, yet falls have continued nonetheless. Fingers are being pointed at US fiscal policy, incorporating Trump tax cuts and higher spending, which unusually is coming at a time of economic expansion and will add to the budget deficit in the world's largest economy. Last year's tax reforms are expected to add as much as $1.5 trillion to the federal debt load, while the agreed budget agreement will increase government spending by almost $300 billion over the next 2 years. The fiscal plans have been making life even more difficult in the bond markets, which must cope with issuance of $258 billion of treasuries in the coming week alone, as the US government readies itself for the spending spree. The yield on benchmark 10-year treasuries touched 2.94% last week, a 4-year high, but started the week off below that level. This week, the Fed releases the minutes of its January meeting, at which the central bank opted to leave interest rates unchanged, but suggested inflation was coming through more strongly than it previously thought. It was stronger wage data, of course, that provided the trigger for the stock market fall that we've seen this month, and the official measure of US inflation came in above target last week. That data was not in place at the time of the January Fed meeting, but it was already mindful of faster rising prices and has changed the wording of its rates outlook to include reference to, quote, further gradual interest rate increases. The market is pricing in 3 rises from the Fed this year, starting as soon as next month, but further evidence that the Fed is worried about inflation could make expectations even more hawkish. A similar conversation is going on within the Bank of England, where the prospect of an early rate rise, as soon as May in fact, is being considered. Last week, CPI inflation was confirmed as being stuck at 3%, which was higher than forecast, but even without that, the mood music from Mark Carney and other rate setters has been increasingly hawkish. High inflation seems to be trumping fears of slow growth at the bank, and wage data due later today will add to the picture. Strong labour market figures and faster rising wages will solidify expectations that a rate rise will arrive sooner rather than later. As mentioned at the top of this, equity markets have continued to build on the recovery from last week. Asian markets led the way, followed by modest rises at European bourses on Monday. Gold flirted with an 18-month high yesterday, near $1,348 an ounce. The metal rose 2.4% last week alone, with investors seeking it out as a safe haven from once again volatile equities. But it's also benefited from the dollar's weakness, which makes it cheaper to foreign currency buyers. The weak greenback has also been helpful to the largest American companies, which have seen a mathematical boost to their overseas earnings, and also stronger demand from foreign buyers with more purchasing power. The S&P 500 was back at 2,732 by the end of last week, having fallen to 2,581 at the start of the month. Oil prices rose last week and remain elevated, with WTI at $62.4 and Brent crude at $65.3 a barrel. Adding to upward pressure has been robust language from Israel's Prime Minister Benjamin Netanyahu, who has warned that the country would act against rival Iran rather than its smaller Middle Eastern allies in Syria. Military from the two countries have been engaged in fighting in the country in the past 2 weeks. Israel has a long-standing policy of resisting any Iranian presence in the already war-torn country. Turning to the corporate diary, it promises to be a big week for earnings at some of the country's largest companies. The banks report this week, while there's also updates from big dividend payers like Centrica and British American Tobacco. At the banks, the headlines are likely to be dominated as ever by write-downs. This time it isn't payment protection insurance, although there might be some of that, but rather loans made to the collapsed builder and services company Carillion. Reports at the weekend suggested that losses at the banks could top £1 billion. Income investors will keep an eye on HSBC, where shareholder payments are expected to be stagnant, and Lloyds Banking Group, which is expected to modestly increase its dividend, perhaps with an extra boost from share buybacks. Other companies reporting this week include Barratt Developments, which will struggle to reassure the market that its current dividend yield of 8.2% is sustainable. Another tempting looking yield is available from Centrica, that's 9.3% on a forward-looking basis. But that's before the numbers this week, which are expected to show falling profits at the energy giant. Centrica warned on its profits in November. British American Tobacco also provides an update, and profits are expected to be firmed by improving sales of non-traditional smoking products, vapes and heat-not-burn cigarettes. Finally, to what for many small investors at least is the most interesting thing happening this week, and that's the annual letter to shareholders in Berkshire Hathaway, due to arrive next Saturday. The letter is authored, of course, by Berkshire Hathaway founder Warren Buffett, and it will be pored over by his army of investor fans. The letter has become a fixture in the investing calendar and is much quoted. There's great investing wisdom in there, of course, but plenty of commentary on the state of America and the world as well. I'll end with something from last year's letter that seems relevant right now. He's talking about periods of panic. Quote, during such scary periods, you should never forget two things. First, widespread fear is your friend as an investor because it serves up bargain purchases. Second, personal fear is your enemy. It will also be unwarranted. Have a great week.